You've just had your best year in the market. Stocks are soaring, the economy is recovering. But what if 2025 throws you a curveball? If you're an investor, 2025 could be a year you'll want to keep a close eye on. After an impressive run in 2024, many people are feeling optimistic about the markets. But here's the catch. Experts are warning that 2025 could be far more challenging than anyone expects. With rising inflation, shifting interest rates, and unpredictable global events, investors may face more hurdles than they anticipate. In today's video, we'll break down why so many professionals are saying that 2025 might be the hardest year for investors in recent memory. We'll look at the biggest risks, everything from market volatility to political instability, and give you a clear picture of the factors that could make 2025 a true test for your portfolio. Chapter 1. Reflecting on 2024, a year of records. Before we dive into the risks of 2025, let's take a quick look at how 2024 played out. This year has been a strong one for the markets, with the S&P 500 up by nearly 22% as of mid-October. It's one of the best years for US stock markets in recent history, following a solid 24% gain last year. And this has investors feeling confident, if not a bit overconfident. But here's the thing. Strong market performance often sets a high bar for the future. History shows that after a major rally, we can sometimes see a pullback or a period of volatility. The big question now is whether the momentum from 2024 can continue or if we're heading into a rough patch. Some experts are already warning that 2025 may not be as smooth sailing as 2024. And today, we're going to explore why. Chapter 2. Key risks and challenges for 2025. Now that we've looked back at the strong performance in 2024, let's shift gears and talk about why 2025 could be much trickier for investors. There are several key risks on the horizon that could bring volatility, and we're going to dive into some of the biggest ones. First up, inflation and interest rates. While inflation has cooled a bit this year, it's not entirely gone. The Federal Reserve has already started lowering interest rates to manage inflation, but that's a delicate balancing act. Some experts worry that inflation could resurge, especially if the global economy picks up speed again, or if governments keep pushing for pro-growth policies. If inflation doesn't stay under control, the Fed might need to raise interest rates again, which could hurt stocks and bonds. And even though we've seen interest rates come down in 2024, they're still higher than they were before 2022. And that's creating pressure for many investors. Next, let's talk about geopolitical tensions. Whether it's the ongoing war in Ukraine, rising conflicts in the Middle East, or tensions in other regions, these global risks could escalate and cause serious disruptions. Global markets are more interconnected than ever, so a sudden escalation in any major geopolitical event could rattle investor confidence and lead to sharp market swings. We've seen in the past how instability in one part of the world can have ripple effects, causing unexpected losses in the stock market. The third challenge to consider, high market valuations. After a strong year like 2024, many stocks, especially in the tech sector, are now trading at high price-to-earnings ratios. What does this mean for investors? Simply put, companies have to continue growing at impressive rates to justify these lofty prices. If corporate earnings fail to meet expectations, or if growth slows down, stocks could take a hit. And some analysts believe that the market may have already priced in too much good news, leaving little room for surprise growth. Finally, we have policy uncertainty, especially with the US presidential election in the rearview mirror. A change in leadership could lead to shifts in fiscal policy, tax laws, or government spending that could impact markets in unexpected ways. If new policies don't deliver on expectations, or if there's gridlock on Congress, the resulting uncertainty could hurt investment sentiment. Plus, tariff changes or global trade policies could add more volatility to the mix. As you can see, 2025 won't be without its risks. These challenges, rising inflation, geopolitical instability, high valuations, and policy uncertainty, could all make for a bumpy ride ahead. Chapter 3: Sectors to Watch. Now that we've covered some of the risks, let's shift gears and talk about the sectors that could see growth in 2025, even amidst the uncertainty. Understanding where to invest during challenging times can give you an edge, and these sectors are worth keeping an eye on. First up, technology. Over the past few years, tech has been a major growth driver, and that's unlikely to change anytime soon. With innovations in artificial intelligence, machine learning, and semiconductors, companies in these areas are primed for growth. For example, chip makers like NVIDIA have seen massive gains thanks to the boom in demand for high-performance computing, especially in AI and cloud computing. As AI continues to evolve, these companies could see even more opportunities. However, high valuations in tech stocks do pose a risk, so it's crucial to stay informed about any signs of slowdown in growth. Next is healthcare. With an aging global population and ongoing advancements in medical technology, healthcare is expected to remain a strong performer in 2025. Companies that focus on cutting-edge treatments, pharmaceuticals, and health tech are likely to benefit. In particular, healthcare providers that focus on cost efficiency and data analytics could see higher margins as more people turn to digital health solutions. With healthcare expected to grow at a 7% annual rate between now and 2027, it could be a solid bet in the coming year. Finally, let's look at energy. This sector is always in flux, but 2025 could be interesting as global demand for energy rises, particularly from tech-driven industries. The shift toward renewables, solar, wind, and hydro will continue, but fossil fuels still make up a large portion of energy generation. As the demand for electricity grows, especially from data centers and AI computing, energy stocks could see gains. Additionally, as countries push for cleaner energy alternatives, companies in renewable energy and infrastructure may experience significant growth. These three sectors, technology, healthcare, and energy, are set to be key players in 2025. They offer potential growth, but also come with risks. Understanding these industries and staying on top of developments in each could help you make more informed investment decisions. Chapter 4: Predictions for 2025. Growth, decline, or volatility. So, what can we expect from the stock market in 2025? Well, predictions are mixed. While some experts are optimistic, others are bracing for potential challenges. Let's break it down. First, the growth predictions. Many analysts are still bullish, expecting a solid performance from the stock market next year. Some are predicting a growth of around 10% for the S&P 500, driven by continued earnings expansion, a strong economic backdrop, and lower interest rates. In fact, lower interest rates could be a major factor supporting stock prices, especially in sectors like technology, consumer discretionary, and industrials. If these trends continue, a 10% growth might not be far off. But not everyone is convinced. Some experts are forecasting a decline. With the S&P 500 already trading at elevated valuations, there's concern that earnings may not keep up with the high expectations. If growth slows or corporate profits miss estimates, the market could face a downturn. In fact, some experts predict a flat or even negative return for 2025, citing the risk of a market correction. The high valuations, combined with global uncertainties and potential policy shifts, could create the perfect storm for a pullback. Then there's the reality of market volatility. Even if the market ends up higher in 2025, there's a good chance we'll see sharp swings along the way. Uncertainty about inflation, geopolitical risks, and economic policies could create volatility, making it harder to predict a smooth, steady climb. This means investors may experience periods of rapid growth, followed by sharp declines. Volatility could be the theme of 2025, especially if the market reacts to unexpected news, either positive or negative. So, while growth is possible, it's clear that 2025 will likely be a year full of twists and turns. As always, the key for investors will be to manage risk and stay prepared for anything. Chapter 5: Strategies for Navigating 2025. With 2025 shaping up to be a year of uncertainty, how should investors prepare? The key is to remain flexible, diversified, and focused on long-term goals. Let's go over some strategies that could help you navigate the risks ahead. First and foremost, diversification. As we've discussed, no one can predict exactly what will happen in 2025, but having a well-diversified portfolio is your best defense. Spread your investments across different sectors: tech, healthcare, and energy, and across asset classes such as stocks, bonds, and maybe even alternative investments like real estate or commodities. This way, if one sector or asset class falters, others may help cushion the blow. Next, focus on income-generating assets. In a potentially volatile market, dividend-paying stocks can offer some stability. Many of these companies are more established and may be less affected by short-term market swings. Bonds, too, can play a role, especially if you expect interest rates to drop. However, remember to be cautious with long-term bonds if rates remain elevated. Finally, stay informed and be ready to adapt. 2025 could bring unexpected shifts, so keeping an eye on economic data, global events, and policy changes will be crucial. Having a flexible strategy where you can adjust your allocations if necessary will give you a better chance to ride out any turbulence. In a year of uncertainty, the more prepared you are, the better. And that's it for this video. Thanks for watching, and stay tuned for more videos to help you make smarter investment decisions in uncertain times. Until next time, take care and happy investing.